Hi, and welcome to my monthly market insights video. My name is Dan Timitich. I'm a managing principal and portfolio manager at T2 Asset Management. Before we get started, remember this video is for educational purposes only. Opinions expressed in this video are mine and do not reflect the opinions of other portfolio managers. You should always consult with a financial advisor before making any investment decisions. Investments involve risk and are not guaranteed. Okay, we're about 2 months into full quarantine. The economy is closed for business and people are officially going crazy. That said, the markets don't seem to really care about any of this. April had one of the best months on record, with the NASDAQ leading the way. It was up more than 15%, followed by small caps up nearly 14%. The S&P was up over 12%, and the Dow Jones was up just over 11%. Even junk bonds were able to pick up about 5%, and the overall bond market, as measured by the Barclays Aggregate Bond Index, was up just about 2%. All in all, it was a pretty good month, which was great to see given all the damage that was done in March. On a year-to-date basis, markets do continue to feel the pressure, but it's obviously nowhere near as bad as it was back at the end of March. For the year, the aggregate bond index is up about 5%. Junk bonds are doing just about as poorly as the S&P 500, but the NASDAQ, the tech-heavy index, is near break-even for the year. As a matter of fact, as I'm doing this video, the NASDAQ is now in positive territory for the year, so that's good news. Looking at the winners and losers for the year, it's much of what you think it would be. The winners are sectors like tech, communications, consumer staples, consumer discretionary, and healthcare, ranging from being up nearly 0.25% for tech to being down about 7% for consumer staples. I find it hard to believe that I'm talking about winners being down only 5, 6, 7%, but that's the world we live in right now, and it is what it is. As for the losers this year, the losers are energy, financials, industrials. All of them are down about 35, 25, and 20% respectively. I think most people were a little bit surprised to see that utilities are down over 10% since that would normally be considered the safety trade. That said, these winners and losers that we just talked about demonstrate the huge disparity between the sectors of the S&P 500. Not all stocks are the same, and if you weren't allocated properly, you're probably feeling a lot more anxiety right about now. You got to remember, 80 to 90% of your investment returns are going to come from asset allocations, so you really need to do your research and analyze the sectors and asset classes that are directly going to affect your investment returns. Too many people want to buy things just because they're cheap. Things are cheap for a reason, and there's no rule saying that they can't get any cheaper. So it's just something to keep in mind as we go through the rest of this year. This graphic here just shows the different dispersion of returns among sectors in a pictorial manner. As you can see, the only sector that was positive for the year was tech. Okay, so what have I been doing in my core equity portfolio? As I've said in previous videos, you want to sell into rallies to capture gains, and you want to stay patient until opportunities present themselves. Well, that's exactly what I've been doing in my stock portfolio. If you recall last month's video, I mentioned that I was fully invested at stocks at the end of March. But as we entered April and we started seeing the market gain some speed, I began to take gains and reduced my stock exposure a bit. By April 15th or so, I was holding about 15% in cash and 85% was still invested in stocks. The market continued to rally in the second half of April and got to a point where, in my opinion, it looked overvalued once again. So I continued to sell into that rally, and by the end of April, my cash position increased to about 35%, leaving me with about 65% in stocks. I've mentioned the need to be much more active in this environment, and this recent rally is it's a good opportunity to reduce some of that risk and take some of those gains. I think the market has run too far too fast given all the uncertainty, and I think it's just prudent to be a bit more patient here until we get a little bit more economic data in the coming weeks and months. So why do I think the market is overvalued today? There are a number of reasons. I thought the market was overvalued to start the year, and that was well before we had a complete shutdown of the economy. Today, the market is hovering around 2,900, which is really the level that we were at last October. And you can't tell me that the outlook today is the same as it was last October. But specifically, there are four major reasons I'm concerned. First and foremost, the economy is going to get hit hard. The fact that we have been completely shut down for about 2 months, that's going to have tremendous ramifications going forward. Now, I know that some of you may be thinking the economy is not the stock market, and you're right, but the economy is the foundation for earnings, and earnings are the stock market. Which brings us to the next concern. I think earnings estimates are overly optimistic once again. Analysts have a hard enough time forecasting earnings when the economy is firing on all cylinders. I don't know if anybody thinks that they're gonna be doing a better job forecasting earnings when we're going through a complete economic shutdown, and where companies aren't even providing any earnings guidance going forward. These next two concerns are not talked about enough, I think, in the media, but I think they will have some serious consequences for our economy. The markets, they're going to really be affected by these two issues. Bankruptcies first are just the beginning. We all expected large retailers to start dropping, but the real concern is other industries, like restaurants, entertainment, venue operators, travel, oil and gas. I'd be really surprised if we didn't see bankruptcy levels exceed those of 2008. This economic destruction is not an isolated event to one specific industry. There are a lot of suppliers that are attached to each and every one of them, and every one of them is going to be affected. And then finally, with over 22 million people losing their jobs in April, and more losses on the horizon, I fear that the displacement of millions of the middle-class families, that's going to push them into poverty. If you take an average income family where both parents are earning somewhere between $50,000 and $60,000 each, they're making a pretty decent living. They're not vacationing in the Hamptons or anything like that, but they have enough to care for their families, maybe save a little, go on vacation. They're basically doing well. When you force that family into unemployment by shutting down their employer, and that employer doesn't have the ability to reopen because the damage done to their business was too much, you've permanently displaced that family. This final point is very difficult to quantify today, but the result, it's going to be felt for years. I'm only going to go over the first two topics today for time's sake, but you can always give me a call or drop me an email with some questions if you want, and I'll be sure to give you some thoughts pretty quickly. Okay, so let's take a look at the economy. The U.S. economy, measured by GDP, is just shy of about $22 trillion. Approximately 44% of economic output comes from small businesses, just under about $10 trillion or so. We've basically shut down the small business sector and allocated somewhere around $700 billion to them through the CARES Act. There's probably another $500 billion or so in various individual benefits for individuals, direct compensation. By no stretch of the imagination is that going to be enough to offset the closing of so many businesses. I agree with many that the second half of 2020 will see some economic improvement, but I don't think it will be anywhere near enough to fix the damage that's been done in these last 2-3 months. The unemployment picture is even more frightening. At the end of 2019, we had about 157 million people working, and the unemployment rate was somewhere around 3.6%. We just got April's numbers, and we lost over 20 million jobs in 1 month. Think about that for a minute. 20 million jobs lost, just like that. This was the single largest loss on record. The next worst month, you would need to go back to September 1945. That's right, all the way back to World War II. And that number was only 2 million jobs lost. I can honestly say that I never, ever thought I would see a number like this in my lifetime. Graphically, you can see that we lost a big chunk of that pie in one single month. Approximately 15% of our entire workforce is gone. April's job losses basically erased all of the job gains that we've achieved since the last recession. When surveyed, most people think that their loss is going to be temporary. About 90% of them think they're going to be back to work at some point. Unfortunately, I don't think that's the case. At minimum, I think about 20% or 5 million of those jobs will never return, and probably another 5 to 10 million of those jobs will take a lot longer to return. both equally as bad. The real problem here is because the longer you're unemployed, the less likely you're going to be able to find another job, and the more discouraged you become, and before you know it, it becomes a never-ending cycle. So this is going to be a very painful number that's going to linger with us for a little while here. Since the economy is not the market, as said earlier, but earnings are, let's take a look at a few things that pertain to earnings. Here we have a table of sectors, their weight in the S&P 500, and the consensus earnings growth rates for the calendar year 2020. This is courtesy of our friends at FactSet. As you can see, economically sensitive sectors like financials, industrials, and energy, they're all expected to see steep declines in growth or losses. While the defensive sectors are expected to see small pickups. Ironically, I think large cap tech should be considered a defensive sector these days, not only for the opportunity, but also how it behaves when the market seems to sell off. So let's take a look at 2019. We saw the earnings of the S&P 500. They came in at around $165 a share. And the current consensus for 2020 is somewhere around $150 a share. Well, based on my models, I don't think we'll come anywhere near that level. When I model out earnings expectations, I calculate a base case scenario, my worst case scenario, and my best case scenario. Then I make some adjustments to my variables to see what happens if my assumptions are wrong. And only then can I really have a real conviction around making investment decisions and what I want to own and what I don't want to own. So without boring you anymore, my baseline earnings expectations for 2020, they're about $135 a share. I wouldn't be surprised as we get more economic data to see that number come down a bit. So how does that translate, most importantly, to market valuation? Here on this table here, we're showing various forward PE multiples, followed by the level that the market should be at given the consensus estimates for earnings as well as my model's estimates. For example, if you look at that first line, using 15 as the PE and the consensus earnings, you would expect the market to be fairly valued at $22.49. Using my estimate, fair value would be somewhere around 2025 and so on. Today, the market is hovering around 2,900, which means it has a forward PE of 20 using consensus estimates. Obviously, it's even a higher multiple using my estimates. Just so you know, the 10-year average is somewhere around 15 PE, and the 5-year average is 17. So today, the market is more expensive than average, and we are just barely starting to reopen the economy. I'm not saying we're going to come crashing down, but my job is basically to manage risk. And what that means is balancing the upside potential with the opportunity for downside losses. And right now, I think the downside risk is much greater than the upside potential. Now, I know a lot of this sounds like doom and gloom, but there are opportunities, and during this chaos, there are going to be winners. There are some pretty positive aspects of the market and the situation we're in right now. First, the Fed has pumped trillions of dollars into the system, and that has clearly stabilized stocks. They've made it very clear that they're going to do anything that it takes to support the economy. In actuality, what they mean is they're going to stand by to help the financial markets any which way they can. If we can get the economy open and running, the amount of money being pumped into the system and that has been pumped into the system is certainly going to act like gasoline on a fire. The only question is when is the economy going to be fully open, and when are people going to be comfortable returning to their spending habits? There are clearly winners and losers. The stock market right now is driven by very few stocks. Obviously, you want to own the stocks that are driving returns up, not the stocks that are dragging the market down. Macy's and Exxon are probably not what you want to own. Amazon, Google, Microsoft, yeah, those are pretty good companies. And that's exactly what I own in my stock allocation. Large cap tech names like Apple, Netflix, Intel, NVIDIA. I also like the communications sector with names like Facebook, Google, Activision, Disney, Verizon. And finally, I absolutely love the cloud computing space, which includes companies like Microsoft, Amazon, VMware, Citrix, Oracle. So you can see here, not everything is really horrible. There are areas of opportunity, and there are reasons for support in the market. I just don't want people investing in things that are cheap just because they are cheap. Winners tend to win, losers tend to lose. So let me leave you with a few final thoughts. I don't think we've felt the full impact of keeping the world's largest economy shut down for months. Yes, we will rebound, but I think it's premature to expect the economy to fully recover in a quarter or two. Active management is important. Given where we are, it is even more important. As many of you know, that's what we do here, and we want to reduce risk when the market is overvalued, and we want to add risk when the market provides opportunity. Unfortunately, many people have been told to just hang in there, and that as a result, they typically sell at market bottoms, and when they're feeling the most pain, and then they want to buy when things start to feel better, like they are today, when things are higher. You're basically buying high and you're selling low, and that's not a path to successful investing. I expect the markets to stay range bound, so I am going to be reallocating more often and rebalancing more often. I do currently have, as I mentioned earlier, 35% in cash, but as for my stock allocation, I have nearly all of it in large cap tech, communications, and cloud computing. Not only do I think that's where the growth and opportunity are, but I also think that's where you tend not to get hurt as bad if we do get another pullback in the market. And finally, please, please, please don't chase returns. As I've said earlier, many people want to invest when things feel better, and that oftentimes means the market is higher. That's really the wrong thing to do. I think these last few percentage points of gain in the market were the result of people's FOMO, the fear of missing out. Many people sold out at the end of March, and now they're trying to get back in so that they don't miss out on the coming returns. Just be very careful. And look, if you're not comfortable managing your own money or don't like your current strategy, we'd love to speak with you and share our strategies so you can decide if we're a good fit for you. You don't have to go through this whole time alone. Again, I always want to thank you for watching. Please be safe out there, and we'll be sure to see you next month.